Welcome to the first episode of our Let's Talk About podcast series, the audio channel of the Luxembourg Capital Markets Association for high-level insights and updates. I am Anna Lindner from GSK Stockmann, and today we have 3 special guests who will be joining us to discuss sustainable finance and more specifically, 3 types of instruments that are highly relevant for the capital markets industry. But before we introduce our guests, let's give you a brief overview of what we'll be focusing on today. In recent years, there has been a growing demand for sustainable investment options with an increasing focus on addressing environmental and social concerns. As a result, several innovative financial instruments have emerged, providing opportunities for investors to support green initiatives while still generating financial returns. Today, we will be exploring 3 types of these green investment instruments that have gained significant attention in the capital markets industry. We'll be discussing the key features, benefits, and challenges associated with each of them. These instruments are green bonds, sustainability-linked bonds, and social bonds. Our guests for today are all experts in the field of sustainable finance with years of experience in the capital markets industry. They have worked closely with various institutions and organizations to promote and develop sustainable investment practices. Please help me welcome Nikki Kaiser, partner at Linklaters Luxembourg, Catherine Fulberg-Müller, partner at Simmons & Simmons, and Vanessa Miller from EY Consulting, also partner. Welcome to the 3 of you. Great to have you all on board. I'm sure our listeners are eager to learn more about these instruments and gain insights into how they can make a positive impact while pursuing financial goals. So let's get started. Today, we will begin by discussing green bonds, a prominent instrument in the sustainable finance landscape. We will explore their characteristics, market growth, and how they promote environmental initiatives. Catherine, can you tell us more about this product?
Absolutely. Thank you very much. So let's start at the beginning. The very first green bond was issued back in 2007 with the AAA rated issuance from the EIB and the World Bank. The milestone of $1 trillion in cumulative issuance since market inception in 2007 was already reached almost 3 years ago in December 2020. Green bonds were created to fund projects that have positive environmental or climate benefits. The majority of the green bonds we see in international capital markets are so-called use of proceeds bonds. Use of proceeds bonds, as the name suggests, fund projects with dedicated environmental benefits, so the proceeds of the issue are used directly to finance the projects, wherever they may be in the world. It works very much like a traditional bond, except that the issuer publicly states how it will use the proceeds to fund sustainable projects. This allows the issuer to market the bond to investors as being green. Now, this of course raises questions around greenwashing, a term we will all have heard more and more of in the past years. Greenwashing is where an issuer markets its bonds as being green, whereas in fact there are no environmental benefits attached. And this has led to the development of certain frameworks and guidelines encouraging disclosure and reporting, for example, the Green Bond Principles established by ICMA. And as a result, investors should be better equipped to evaluate environmental impact of a given investment and with more transparency try to minimize greenwashing in the industry. In Luxembourg, we've been well placed to follow the development of green bonds, in particular with the launch of the Luxembourg Green Exchange back in 2016 as the world's first platform fully dedicated to green bonds. Although it was the first type of sustainable or ESG-related bond, and today we have many more types, it continues to be an important instrument in international capital markets and in sustainable finance more broadly.
Excellent. Thank you, Catherine. After that, we will shift our focus to sustainability-linked bonds, or in short, SLBs, which have recently emerged as an innovative financial instrument. We will unpack their key features, including their dynamic nature and the potential influence they have on issuers' environmental performance. Nikki, the floor is yours.
Thank you, Anna. The sustainability-linked bonds emerged first in November 2019 with an issue by the Italian energy company Enel. Today, they represent about 5% of the ESG bonds listed on the Luxembourg Green Exchange. Let me give you a short overview of their most important features. The defining feature for SLBs is that their return or other characteristics are tied to the issuer's overall performance against certain predetermined sustainability objectives. So it's not like what Catherine mentioned in relation to green bonds or what Vanessa will mention in relation to social bonds, that it's a use of proceed bond. It is more a general corporate purpose bond. That means that they can be issued by issuers as well who do not have a special green or social project. Basically, they can be used by any type of issuer whether corporate or even a sovereign. Sustainability-linked bonds thus aim to further the key role that debt markets can play in funding and encouraging issuers to contribute to improved sustainability. Shortly after their first appearance, the ICMA published the so-called Sustainability-Linked Bond Principles, which provide for the 5 basic concepts defining sustainability-linked bonds. The 2 main concepts are the selection of key performance indicators, or KPIs, and the calibration of the sustainability performance targets, or SPTs. One or several KPIs are chosen by the issuer and relate to the company's core sustainability and business strategy, while also addressing relevant environmental, social, and/or governance challenges of the industry the company is operating in. This means that a good KPI for one firm may be insufficient for another one. The KPIs must be measurable, verifiable, and comparable in order to measure their real impact. An example could be the reduction of an issuer's CO2 emissions by switching to electric cars. This might be very relevant for a big taxi company, but it may be less relevant for a corporate that only uses cars very rarely. The second concept, SPTs, is inherently linked to the KPIs. Essentially, the issuer's sustainability performance is assessed against one or more SPTs, which must be an ambitious improvement of sustainability on a predefined timeline. This would mean reduction of CO2 emissions by switching to electric cars by, for example, 50% within 5 years. And then there's the link of the KPIs and SRTs to the return or other characteristics of the SLBs. This will have an impact on, for example, the financial return of the instrument, which depends on whether the targets are reached or not. Typically, one would see a benefit or a penalty mechanism, or even a combination of both. For example, interest rates would go up if the targets are not reached, or go down if the targets are reached. And finally, regular reporting and also the obligation of verification is important because this will help in the fight against greenwashing in the context of SLBs.
Thank you, Nikki. Fascinating insights. Finally, we will wrap up today's episode by exploring social bonds, which serve as a bridge between investors and socially impactful projects. We'll discuss how social bonds address some of society's most pressing issues, such as poverty alleviation and access to education. Vanessa, what would you like to share with our listeners?
Thank you, Anna. Yes, indeed. When we think about ESG, we usually first think about green finance, but the acronym also refers to social actions. And like green bonds, institutions that engage in sustainable finance can also issue social bonds. As you mentioned, those are debt instruments used to finance social projects whose purpose is to address a common social problem and help those most vulnerable. With recent rising social concerns over the last years, coming, for example, from COVID-19 or the geopolitical context, social investment needs have really increased. And in 2020, the European Union's SURE program, Support to Mitigate Unemployment Risk in an Emergency, issued in Luxembourg a one-of-a-kind social bond to help the employment. But we can see also other areas that social bonds can support, like, for example, health, for projects for things like buying beds for hospitals, housing, or utilities to help households pay for electricity, heating, etc. Catherine referred to it. The exponential growth of the Luxembourg Green Exchange since 2016 also reflects the key role of sustainability in international capital markets. A good example here is how in May 22, a new flag was created on products specifically to highlight securities that allocate a portion of their financing to concrete projects and strategies that advance gender equality objectives and contribute to UN SDG 5. The growing market potential can also be seen in the numbers. As per International Finance Corporation, for cumulative progress from 2017 till 2022, the social bonds accounted for almost $5 billion and covered over 240 projects linked to the SDGs. But as this market grows, assurance about the use of proceeds and the operations is key for investors' confidence and can provide early insights in potential risks of greenwashing, as Nikki just explained a bit. And last but not least, we'll also look at the evolution of social bond frameworks and requirements, together with the development of the EU social taxonomy that can set up clear guidance and indicators for measuring social impact. So much more to come in this space as well.
Thank you, Vanessa. Thank you to all three of you for sharing your expertise and guiding us through these crucial topics. That wraps up our introduction for today's episode of Let's Talk About. Get ready to explore the world of green investment instruments with 𝘮𝑥 and discover how they can shape a more sustainable future. Stay tuned for our upcoming podcast, where we will try to demystify the EU taxonomy. Don't forget to subscribe to our podcast and join us for future episodes where we continue to bring you the latest insights and updates on the world of sustainable finance. Until then, keep thinking green